Pretty usually, everything on this channel is for educational purposes only, is not intended as financial advice. Markets have been so quiet lately that I was going through my bookmarks, doing some organizing, riveting stuff I know, but I came across this Market Watch link that I kind of forgot about, but every week they put together the important macro stuff in the US. Today, of course, Labor Day. I will honor that by talking about labor in the opener here, but one thing that caught my eye was just the number of Fed speakers. I don't think this is a conference, but it very well could be. I have no idea what all this is. Very rare to see that many speakers on the same day, from what I can recall. There's also another speaker on Friday. And I also think it's unusual that we're getting this many speakers before CPI, but I don't know. Probably just a coincidence. I don't think it really means anything. So Thursday's going to be fun. You're going to have a bunch of Fed commentary on rates. Obviously, are we there yet? Are we going to keep going? When's the recession? What are we focused on? Jobs. There's also initial jobless claims, which are pretty important on Thursday as well. Let's talk about unemployment and jobs first. As CNBC put it succinctly, it has been the summer of strikes. We have the SAG-AFTRA stuff. We have writers' strike, LA hotel strike. We had a strike in, I believe, Australia. What was it? Natural gas, Chevron, Starbucks, Dunkin', tons of union efforts. I'm very pro collective bargaining, very pro union. So it makes sense to me to see this when we're coming off of hot inflation numbers. Cost of living in many spots has gotten out of control. And what is a worker to do? Either find a new job or ask for more money, right? Or go homeless, I guess. I mean, what do you do? So that was the beginning of August. And now at the end of August, we get another story on strikes. More than 320,000 workers participated in at least 230 strikes this year. I always, of course, am looking for some visuals on that. I have that in this article. But as far as work stoppages since 2017, with 1,000 workers or more, not super significant. But then when we're looking at the number of workers involved total since 2017, this appears to be significant. Didn't have too many strikes during COVID, during PPP, during stimmies. And as that sort of is running out, as we're dealing with the long-term effects of inflation or the longer-term effects of inflation, I think that's why we're seeing what we're seeing in the labor market, asking for more money. Pilots as well. UPS, that was another highly publicized strike. I don't understand the anti-worker bias that seems to bubble up on social media, especially highlighting, that $170,000 contract that very few workers are actually getting or will get, as far as I understood it, and it only happens at the end of a 5-year term. But of course, how dare you ask for more money? You need to pull yourself up by your bootstraps out there. Labor strikes since 2021 across the U.S. here. And again, it's been significant. You don't always hear about some of these. Some of these are school districts. Some of these were meatpacking plants, right? But I think the recent strikes affecting many people in the areas hardest hit by cost of living, California, New York. And if we look at the generational breakdown, of wealth, a lot of millennials don't have it. Now, this isn't to say we need wealth redistribution, but eventually this wealth will be redistributed by inheritance or helping the younger generation via the baby boomers. But in the meantime, we are seeing significant youth unemployment. China was the latest headline. China's youth unemployment was so bad that they've decided to stop releasing the data as it is. Most of the data in China is either under a black box or not exactly 100% truthful. Now, it is dangerous to compare unemployment across multiple countries just because you have a variation on what counts in those countries as data points. So unless they're correcting for that, it's tricky. But US youth unemployment down here at 8%. But for China, that is highly, highly significant. And I will admit, I've never actually opened a BLS news release for employment. This is what it looks like. The number last month was at 3.8%. Non-farm payrolls increased to 187,000 in August. So we are still seeing increases in employment before the adjustments, because even if we look at when the adjustments occur, we've adjusted down, we've revised down for every month this year. And if you look at the difference there, it's wide and growing. So it's not negative, but as many people suggest, there's some nefarious meaning behind it all. For me, it's just, you can't really trust any of the data from any government regardless. So we got to go off something. This is the best we can get. At least they're revising it in a truthful direction. But at the end of the day, no one really cares about the revisions as much as the initial numbers. The initial numbers always get all the headlines, and the revisions are kind of just, not in the spotlight as much. The ADP numbers were also down significantly month over month and well below expectations. So there are some hints at some cracks in the jobs market loosening a little bit. This is job openings, JOLTS as it's known. And as Lizanne Saunders points out, this is the largest decline on, I believe she said, 3-month decline on record. And as silly as the JOLTS metric may seem, it is something that the Fed uses. Specifically, Powell has mentioned several times in the press conferences as far as what's an important data point to pay attention to. And as BOA sort of points out, if we look at historically, Fed funds rate in the dark blue versus the JOLTS to unemployed ratio. I love how ultra specific we massage the data points and then try to have a conclusion. It's just funny because, obviously if you're massaging 55 data points and 50 of them don't make any sense, you don't point those out. But anyway, I digress. This chart looks amazing in a sense that, yes, this job openings to unemployed ratio, when it begins to decline, does suggest the Fed is done. So this is one of the strongest pieces of evidence that I've seen in the past week based on the data, other than just JOLTS, that the Fed is probably done. The Fed is probably going to stay put on rates here and not going to continue to hike. Quits fell as well. Another data point that they watch closely, as you'd imagine, in 2020 post-COVID, quits started to increase with stimulus that's, for the most part, largely gone now, and quits have returned to their pre-pandemic level. And in the blue there, you'll see the wage growth tracker also on its way down. And the argument here is that the wages will follow the decline in quits. One thing about the labor data, I don't know how they count striking workers in that. The same thing with the wage data. I'm not exactly how that works out on the back end on the raw data side of things. Are they counted as out of the labor force? Are they counted as unemployed? I'm not exactly sure. And the same thing for the wages data. How does that get baked in to the data? Not exactly sure. Another interesting, talk about massage. If we look at year over year of job openings and the S&P in the red, job openings in the blue, we do see divergences from time to time. We certainly are seeing a very large divergence now. However, most of the time, these tend to be together, at least on a directional basis. So this may suggest, one way to read this, upcoming weakness in the S&P. Something's got to give here, right? The jaws have to close, as you'll see on some of these other charts, TLT versus NASDAQ or whatever you're looking at, right? Something's got to give here eventually. Before I talk about inflation, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro at the link in the description of this video. And they recently introduced iceberg orders, which allow you to set a large order semi-hidden in the order book. So let's say you want to sell 10 BTC and you only want to set a visual in the order book for 1 BTC at a time. This is one way to do that instead of doing it manually, perhaps. And it allows you to covertly place a larger order without jostling the order book around. Looking at inflation, true inflation reporting 2.66, sort of hovering around 2.7 plus for a little while there. Still below 3%, thankfully. Now we're sort of battling the energy data, which I know this is hard to see, but gasoline has crept up here, begun to rise again, and we're certainly feeling that on the year-over-year data. Now we also know that housing is a lagging component, so we're dealing with that as well, question is which is going to win out? Is the gas price going to remain higher for longer versus housing coming down in that CPI component? I believe this is a 5-year high at Labor Day for national gas prices, which is certainly concerning to say the least, especially for that energy component. This is the monthly rent data, year over year change down significantly now. And that has yet to work its way through on the CPI, even though it has worked its way through in trueflation. Now the Cleveland Fed now casting 3.8% for CPI. Hopefully this is a well-known forecast that will not shock the market when we see a month-over-month rise in CPI. From August to September looks like it's going to be about flat so far. So if we look at the rate probabilities, essentially saying we're going to probably hold for the next good long while, higher for longer, until something breaks, until something blows up. The Fed is unlikely, based on what the market's suggesting here, to continue raising. So if you are a bull, you probably hope that we stay higher for longer, because then that means nothing blew up, you know? Eventually things get soft enough, or we see recessionary conditions where the Fed untightens the screws a little bit and rates come down. Now, if we look at everything together, CPI, core PCE, trueflation, nowcast, and we're still much higher than that 2% target. Inflation or unemployment is still historically quite low as a percentage. So they certainly have justifiable ammo to just continue to hold here and have some attempt at bringing inflation down while unemployment remains low. And if we look at some data on when we get a recession relative to the start of the hiking cycle, the average is around 22 months. We're about 17 months in. So we got a few more months here still. You know, I wouldn't quite join the no landing camp just yet. I think we've yet to see the full effect, especially if the US consumer is just completely tapped out. On top of everything else moving higher, which I'm about to look at in a second, student loans coming back online. This month, with the first payment due at the end of the month, we'll begin to see how bad those delinquencies are, probably mid-October, I'd imagine, with November at the latest. We're going to see some interesting numbers on actual delinquencies instead of just saying, these loans are in forbearance or these loans are temporarily forgiven, whatever the verbiage is there. And that certainly won't help consumer spending. Looking at some other data points for leading indicators for a recession, basically my read on this, based on the number of consecutive monthly declines in these indicators, is we're due for a recession sooner than later, right? We're in the wheelhouse for that 2-year sweet spot eventually coming up. I don't think the question is whether or not we're seeing weakness or will see weakness. It's what are you going to do, right? If you're bearish stocks, you push into cash, go into bonds, sure. But it's not like bonds have been a walk in the park either. And if we look at another chart from the end of, mid-March, let's say, sort of reminding us that the yield curve does get steeper prior to the recession. It's the unsteepening that usually is the bellwether for recession. So we got plenty of time, right? Meanwhile, we're still spending money out the yin-yang here, plus 53% in national debt. Past 5 years, we've added, what does he say, 1.45 trillion, as Charlie points out. Since the debt ceiling was suspended 3 months ago, we are potentially unsuspending the debt ceiling or whatever mumbo jumbo politics garbage that's going to happen in the next couple months. Apparently McCarthy is working on a Biden impeachment in order for the government to not shut down. That's kind of a really bizarre set of circumstances, but I guess the rationale is if a Biden impeachment process is active, the government is less likely to shut down. So good for him, I guess. I don't really know how that's a better outcome for everybody, but it's not like impeachments mean anything anymore or ever have, honestly. But anyway, that's something fun to look forward to in Q4. This has kind of been the doomer chart of the week. Foreign holdings of U.S. Treasuries, specifically in China, as people are pointing out, the lowest they've been in many, many years. And the question again becomes, okay, who's going to buy our debt? If it's not China, if it's not the Saudis, if they're selling, if they're net sellers, then rates go higher. If we look at the reverse repo, the inert cash that is just kind of sitting on the sidelines, that is also being drained at a decent clip again. So if this fully gets drained and we still haven't figured out the debt situation, we may be in trouble. Another read on this is that if money's coming out of the reverse repo, more people think we are towards the end of the hiking cycle. It'll be interesting to see what this looks like when rates start to come down again. So far we are not flashing complete danger warning signs, but we're getting there. Another maybe danger warning sign is tax receipts declining. If tax receipts decline, debt obligations increase. That just widens the gap effectively. So that's certainly also a problem. And globally, it's, this is why we Bitcoin right here. Globally, it's completely out of control. And of course, your weekly, consumer households just far below the pre-pandemic savings trend. And this is only going to get worse with student loan payments coming back online. Housing for most people is going to be completely out of reach for really quite some time. And kind of the scary thing, I think, with this graph is people who are buying houses now versus people expecting a housing crash. If there is a housing crash, then the people buying houses now will be underwater effectively, or their house will be worth less than their mortgage. And that will also be a very big problem, as we've saw in 2008. This is also disturbing. In June, buyers who own 3 to 9 properties accounted for almost 50% of housing purchases. So the hoarding continues. Real estate investors continue to buy up those properties. Now moving to car loans, average hit a new all-time high for car loans of a new car in the United States, $733. That's average. The used car index, still far above its pre-pandemic trend, coming down, but still far above. Now, as we know, average rates for used vehicles, 11%. And if we look at monthly payments above $1,000 for new vehicles, in many states, far above 20%. So when we put everything together, I don't think it's unusual to see the number of labor strikes we're seeing. Now, you could argue, well, those people just shouldn't be spending that much money, or they should be living within their means. I'd agree with you. But for many people, there's just nowhere to turn when everything continues to get more and more expensive. We are seeing credit card loans in small banks experiencing rising levels of delinquency. So again, if you are tapped out, you go to the credit card goes delinquent, then what do? And I think we're going to see more of this with the student loan stuff, which has seen a decent clip of repayment as those payments go back online. So it's not like everybody's not repaying their loan. We certainly saw, whether this is refinancing or whatever it is, we are seeing some of that money start to come back into the TGA. As far as the stock market's concerned, it's been very quiet. Look at funding, venture funding across the board, down, quiet. I'm surprised there's even 104 IPOs this year. I know of maybe 3, so I'd love to see this sorted by market cap or something, but pretty quiet out there. We have Instacart coming up. We've got Kava that happened earlier this year. And as bearish as the S&P might be based on current conditions, looking at momentum when returns were significantly positive for the rest of the year, it's almost always been positive. So again, something's going to have to give here, and we may not truly experience that until 2024. Meanwhile, retail still pushing tons of money into the market, and that may just spell disaster as they are buying the top. But we will see. We will see how this looks towards the end of the year. Meanwhile, you've got NVIDIA CFO selling at these levels. So I don't think anything is super clear right now. Strong dollar, strong oil, maybe S&P and the Qs roll over. Certainly decent technical evidence to point towards some sort of mean reversion behavior. And it may just be a battle of the dollar and oil as we approach the end of the year, with US equities kind of just ranging at the top here. Looking at the tech stuff, everything kind of looks okay. Like it's ready to regain steam. Apple, Microsoft still in the cloud. NVIDIA still looks okay. up here. I mean, it's not for me, but it doesn't look completely terrible. Google looks fine. Tesla, similar to Microsoft, kind of deciding whether or not it's going to regain strength. Meta in the Apple boat here, looking like it's ready to regain strength. Netflix looks like it's ready to negate that Head and Shoulders that looked like a decent setup. And just randomly, Hasbro over here, breaking out of a inverted Head and Shoulders. So it's not all doom and gloom across the board. There is still time for things to happen towards the end of the year. Don't let the macro doomers get you down. Doom may be inevitable, but we are delaying it here a few more months. So that's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.